Hi, this video is going to look at the component of financial statement. Why am I doing this? Well, it's one of the things that you need to know about in this section here in the specification, analysing the financial performance of the business. I'm basically going to cover these three bullet points where we're going to understand the importance of financial statements for assessing business performance and helping to make decisions, looking at the main component of the statement of the financial position, and hopefully you should have a clear understanding of the difference between assets and liabilities, and you should understand what this phrase means about the statement of financial position being a snapshot in time. So there are two financial statements that you need to be aware of. One of them is the statement of financial position. The other one is an income statement. There's more to learn about the income statement, but let's look at the statement of financial position first. Well, sometimes you will hear people talking about celebrities and they'll say, oh, David Beckham is worth X million pounds. I've got no idea what it is. Let's just say David Beckham is worth 600 million pounds. You also might hear somebody saying David Beckham earned 50 million pounds last year, or whatever it is. Okay, there's a difference between those two things. How much money I earned last year is different to how much money I'm worth. And these two different documents answer those two questions. The income statement, which I'll talk about in more detail, answers that question. How much did you earn last year? Okay, and for a teacher or some sort of professional, it will be between £30,000 and £50,000 for the highest paid teachers. How much are you worth is a totally different question because it depends on what assets those people have. Okay, so I'm lucky enough to own a flat in London. That's an asset. I've also got a car. That is an asset. Now, businesses have assets too, and the statement of financial position is a document that looks at how much that business's assets is worth. It says if I paid off all of my debts and I liquidated all of my assets, if I turned all of my assets into cash, how much would my business be worth? And that's what this document, the statement of financial position, shows. It's a given point in time. You can only do this on a day because you've got a certain amount of stock in a business and it's moving back and forth. So the statement of financial position says on this day, if I were to sell off all of these assets and pay off all of my debts, this is how much money I would get at the end of it. And it answers the question, how much is your business worth? So whenever you hear someone say something along the line of this celebrity is worth 600 million pounds, well, that means if they sold off their cars, their houses, they paid off all their debts, then the value of all of their assets combined would be 600 million pounds. Well, the statement of financial position, previously called a balance sheet, but in the specification they do call it a statement of financial position. Well, what does it do? It tells stakeholders how much the business is worth and would help somebody decide whether they want to invest in a business, whether they want to lend it money, or whether they want to buy the organisation. And below is an example statement of financial position. Okay, and I'm just going to talk you through it very quickly because in the specification, all it says that you need to know are the main components of the statement of financial position, and you need to understand that it's a snapshot in time, which I've already kind of talked about. So let's have a look at this example statement of financial position. So these things are a bit like learning a new language. There are assets and there are liabilities. Both of those words are identified in the specification. You need to understand the difference between assets and liabilities. So what is an asset in business terms? Well, an asset is something that is going to earn the business revenue. It's going to be used to earn the business revenue. And some examples of assets would be things like factories, vehicles, any other fixed item that would be used to earn the business money. Okay, the machinery that they've got. And there are two types of assets you need to be aware of. There are non-current assets and there are current assets. So non-current assets are fixed assets that are going to be used to generate income in the business for more than 1 year. So that would be the machinery, the factory building, etc. That's going to be around for a long time, and it's going to be used to generate income for the business for more than 1 year. In this example, the non-current assets are worth 100 million. Okay. Next up is non-current liabilities. So if an asset is going to be used to generate revenue for the business and a non-current asset is going to be used to generate revenue for the long term, a non-current liability is a debt that the business has in the long term. Okay, bank loans would be a good example of this. So in this example, the business, and I'll get the calculator up to show you, the business, if they sold off, excuse me, taking a while to load, if the business were to sell off all of their fixed assets, the business would get 100 million. They then have debts to pay of 25 million. So that takes down the current value of the business to 75 million. Well, they've also got some current assets. Well, current assets are going to be turned into cash in the next 12 months. They would include things like stock, money owed by debtors. So if I've given trade credit to some customers or whatever, that would be a current asset. And cash itself is obviously cash already. So these are my current assets. They're going to be turned into cash within the next year, whereas my non-current assets are going to be used to generate income for the business for a period of over a year. So this business has 40 million worth of current assets. So that takes our value of the business up to 115. Let me just check that again. Okay, so 115. The business also has current liabilities. So if non-current liabilities are long-term debts, this business also has debts that it needs to pay in the next 12 months. For example, maybe they've got trade credit themselves or something like that. So we have to take that off the value of the business because that 35 million is going to be leaving. That takes us down to 80 million. And we can say the net assets of this business is worth 80 million pounds. And if this business would decide to liquidate itself today, which basically means to turn itself into cash, sell all of the assets, pay off all of the debts, there would be 80 million left over, and its net assets are worth 80 million. So that is asset and liabilities. There's also it doesn't indicate that you will need to know this at all, but you can also see on a statement of financial position where that 80 million has come from. Well, in this case, 70 million of it was invested by shareholders, and they've also acquired 10 million from retained profit. So this is where the 80 million pounds has come from. All right, it used to be called a balance sheet because that total value of the business that had to come from somewhere, and the total equity told you where it came from. Okay, so that's in a nutshell the statement of financial position. It should hopefully have told you why it's important. Okay, it will tell me how much the business is worth. You've had a look at the main components, and hopefully you understand the difference between assets and liabilities.